Hey there, I'm Bruce, and today we're going to be talking about credit cards because the exciting news just came in the mail. This is the Platinum One Quicksilver. It's my second credit card. A lot of people recommend the Capital One cards as great introductory credit cards to start building your credit. And in this video, we're going to talk about it. Now, the video is going to be somewhat anecdotal, talking about my own experiences. I'm fairly new to credit, but I want to give some good tips that I think I would have wanted to know sooner. There are a lot of people that disagree, but I think having a credit card is absolutely essential. If you're a person that ever wants to finance a house or take out a loan one day, you're going to need a history of credit. And having that magic piece of plastic, that card, is going to help you get there. It's absolutely essential, and here's why. Quick side note, I just started this channel, and this is my second video. The elevator pitch is I'll be making videos about filmmaking, personal wellness, and financial literacy. However, I'm not an expert in any of these areas, and I'm still learning. And I'm making these videos so that I can give my perspective and some advice. So I'm happy that you're here learning along with me, and let's get back to the video. For years, I never had a credit card. I always heard these horror stories of people owing big on credit and bankruptcy and all this stuff, but I never thought about the other side of it. When I was younger, what are the benefits of being responsible with credit? There are a lot of advantages. Some being leveraging your money, leveraging debt in order to acquire more assets. You can think of it as like buying a house with a mortgage on it. Whereas the value of a house is maybe $500,000, you're able to buy a house with $100,000 by leveraging debt. And that is by using credit and using a mortgage with the bank. And the bank really wants to see that you are credit worthy and that you have a long history of making payments, because they don't want you to become delinquent on those payments. They want you to pay your loan every single month, month in, month out. So having a credit card is very valuable for that. Very valuable for showing creditors that you are responsible with money and that you always pay back on time. When I was 17 years old, I swore off them. I said, I'm never gonna get a credit card. I can do well without this system. But this is an important lesson to learn, because even if you don't endorse credit companies, it's really hard to advance your credit rating without having a card. After so long of leaving credit out of my life, I started to learn that so many things in life, even like applying to live in an apartment, requires that you have a credit history. What even is credit? Credit is the ability to borrow money from a lender with the promise that you, the borrower, will pay the lender back later. A credit card is a little piece of plastic from financial institutions that lets you borrow money from a pre-approved limit to pay for your purchases, such as going to the grocery store. Instead of you using a debit card, which takes money directly from your bank account, using the credit card takes money out of a credit account, which is money that you'll have to pay back later. A very important rule to being responsible with your credit is making sure that you pay off your card in full every single month. That is because the really high interest rate, the APR that you see on those credit cards, is only applied to the money that is left in the account after the payment date. So if you pay off everything that you borrowed before that date each month, it's essentially like borrowing money for free.
But Bruce, what would the point of borrowing money be if I already had money? Isn't the point of having a credit card to borrow money that I don't have?
No! Look at some of these numbers. Some credit cards, if you pay just the minimum amount that they ask you to pay each month, you might never pay off. Really, it's not that scary though. It's just be responsible, keep your head up straight. Instead of letting credit cards become debt receipts to your lenders, they can be a great tool for building rapport with your lender. Because the more you borrow money and pay it off, the more it shows that you'd be a good candidate to pay off other debts that you have in the future. Okay, so what is a credit score and what factors into it? A credit score is a number that ranges from 300 to 850. That is determined by a pooled collection of reports from 3 credit bureaus. In the US, that is Experian, TransUnion, and Equifax. They compile information about the consumer's borrowing habits and use that to create reports for lenders. Here's where the magic happens. They'll use a few factors to determine your score, and I'll break it up in this pie chart here. Credit mix, 10%. This means diversification of your credit. If you have multiple credit cards or multiple loans from different lenders, then that reflects well on you because it shows that you're diversified and you can juggle a lot of different financial obligations. So they like to see credit mix, 10%. New credit, 10%. This is where the bureaus track your recent addition to credit, whether this be a credit card or a new loan. Applying for new accounts quickly can have a downward impact on your score, but it's not too major and it's not a big deal if you're strategizing for what you're applying for. Length of credit history, 15%. The longer you have credit, the better this area will be. Simple as that. Lenders like to see that you've been using credit for a long time. Amounts owed, 30%. This is where a thing called utilization matters. Whenever you get a credit card, you have a limit or amount of credit that you can borrow. Creditors like to see that you have a high limit, but they also like to see that you're not utilizing all of this credit. A good ratio mix is 30%. Say if you have a limit of $500 in a credit card, you really don't want to use more than 150 of that, or 30%. To be really safe and to get the best marks in this area, I recommend using less than 10%. I do this as well. Payment history, 35%. Lenders love to see that you're consistent in paying off your debt obligations every month. So it's very important. It has the biggest weight on your credit score, and it's very important that you are consistent in being accountable to the debt that you have with lenders. Having a high credit score opens up so many financial doors for you. You get better interest rates, better mortgages, higher loan limits, higher credit limits, better credit cards, access to better credit cards. And consistency is key. Make sure that you're using your credit and paying everything off responsibly. I probably said this a dozen times in the video, but really it's the biggest thing. If you're just being consistent and just being accountable to your credit cards, then you're gonna have no problem. It's really exciting for me to have a second credit card. I mean, some people have like dozens of credit cards. This guy on YouTube has 13. And speaking of this guy on YouTube and other people on YouTube, I first started learning about credit cards from YouTube and watching videos, and there's probably a lot more informative knowledge out there. Knowledge is the greatest power anyone can have. So I encourage you to keep on learning and keep on building your financial skill sets and keep on going. That's it for today's video, everyone. Thank you so much for watching, and please, if you like the video, give it a like, hit the notification bell if you want to see more videos like this. I post videos every Monday and Friday, and I hope you're having as much fun as I am with these videos, so thank you so much for watching. Goodbye.